The property boom loses. Let's have a look. Hello everyone, Florian Heise here and welcome to another episode of HeiseSays. I've got my $1 7-Eleven coffee, hashtag not sponsored, and I thought we'd have a look at this article from news.com discussing, let's say, the less fortunate people from the apparent property boom that we're having here in Australia. So I thought this is quite interesting that they're actually discussing this in public, because we seem to be getting more and more and more, or maybe I'm just discovering more and more propaganda pieces, shall we say, that are just pushing this narrative that property is booming. And, you know, it's gone up. Property always goes up. It can't go down. It can't go down. There's probably a generation of people that actually believe that. Let's have a look at this. So the national story of property prices is not reflective of many markets in Australia. And, you know, Elliot, Hasty, good work that this is actually being discussed on news.com. I think this is fantastic. This is good. So the Australian property market is showing signs of slow recovery, but not every homeowner is making a profit from the rebound. So he's not denying that fact that there are signs of recovery, but not every property owner is. And that is displayed very clearly in this diagram here, which shows the properties on the western side of Sydney, the units, how their growth hasn't been equal to that. They've actually lost compared to the eastern side. And this is referred to as the Red Rooster line. Now, I looked that up, and here is the Red Rooster line. So it's the hipster versus the rooster line here. You can see what goat cheese curtain and the Red Rooster line here. I mean, need I say any more? So, Australia's insane property prices have created some pretty big losers. And it is not just the younger generations that are missing out. Australian property prices are still among the highest in the world compared with income, with Sydney and Melbourne's real estate prices particularly soaring. And I'll get that right eventually. I just want to bring up this chart here showing housing affordability relative to income. And see how it's climbing at 2012? It's gone up a lot higher than that. And wage growth, well, it's a bit of a joke, isn't it? So any claims, how can you measure the success of a government? The living quality and the ability for their civilization to reap the benefits of their governance. Has that been achieved in the last 20, 30 years, regardless of who's been in power? For this reason, the government has introduced a range of new initiatives to help Australia's youngest generation get their foot in the door. One of those initiatives, the First Home Loan Deposit Scheme, allows for 10,000 eligible home buyers to purchase their first home with a 5% deposit instead of the usual 20%, thanks to the government guaranteeing their mortgages. See, this is the thing. When you borrow such a low deposit, don't you have to take out mortgage insurance anyway? So who's taking the risk? The insurance company? And now the government wants to get involved. I mean, I'm really happy this is capped at only 10,000, because this is starting to go down the path of what happened in America. It's not a good sign. Guys, it's not a good sign. The scheme kicked off this year, but it was in fact last year that marked the biggest surge in first home buyers on the market. However, CoreLogic research director Tim Lawless told news.com.au the surge of new buyers would not last, particularly as investors returned to the market. Mr. Lawless said as property prices climbed, investors would return as there was money to be made. Investor activity is likely to ramp up as the prospects for capital gain start to become more widespread, and the spread between rental yields and mortgage rates remains around record levels. So here we have the problem with this artificial cash rate. It's going to hurt first home buyers, everyone. This is an artificial intervention into the market. The 10,000 guaranteed loans is an artificial intervention into the market. And all these people who are trying to get into the housing, all the young people, they're paying taxes, they're working hard, they're sacrificing, and it's kind of like they're being shot in the back. You know, this is eroding their chance to get any interest on their savings, and it's going to drive more investors into the market and drive up the cost of housing. So investors have in the past been blamed for the high property prices, causing both rent and affordability spikes. Well, if we have a look at this one here, this is from the Foreign Investment Review Board. You can see how high, the black line there, how high foreign investors were in our market between 16 and 17. Over 90%, guys, of building approvals were driven by this part of the sector. It's ludicrous. You wonder why it's overheating. You wonder why there's an affordability issue. You wonder why young people just give up and say, screw it, I'll just buy Avo and MASH. So feeling the pain. However, recent figures show investors may not be making the money they used to. According to the latest CoreLogic Pain and Gain report, 16.6% of investor-owned properties nationally sold for a loss last quarter. So there you have it. Some people are getting out. Are they preparing for what's to come? Are they worried there's going to be a crash? Is it because arrears rates are going so high? This happened in every market across the country except Hobart, but CoreLogic analyst Eliza Owens warned about just looking at the national story, and this is the problem. I mean, this is what we get in all these articles. They're just looking at the national story. It's hard because we see the gains in the national markets, but realistically, there's been weaknesses in many subsections, like mining communities, like in Perth and Darwin, and even in apartments, she said. Well, yes, there has been, and I will bring this one up to show everyone. Look at all those apartments in the red, all those units. According to Ms. Owen, the biggest gaps were found in capital cities, where 17.2% of investors sold at a loss compared to 11.1% of owner-occupiers. Cities like Darwin and Adelaide were at least 20 percentage points difference, and even in Melbourne there was a gap of 9 percentage points. However, Ms. Owen said this was normal, as typically investors did not place the same care in a property as owner-occupiers. Investors don't have the same stake in it, so there isn't the same relationship to the property, she said. The other thing is investors may be more capable of copping a loss because they can offset it with future capital gains. So market cycles. Realestate.com.au chief economist Nerida Conisby told news.com.au, investor troubles were also caused by issues relating to the stage of the cycle the market was in. We tend to see this as the early stages of recovery, where the premium quality suburbs see a rebound, which typically isn't where investors are, she said. There were other practical reasons why investors were missing out, Ms. Conisby said, most of which related to the types of properties investors tended to hold. Apartments don't outperform houses in Australia on average, and investors tend to be more focused on those. Investors are focused on lower price and lower cost areas, and at this stage, the cycle will continue to miss out. Is it just the cycle, guys? This is the thing. Are we seeing a dead cat bounce? Has it, a decline in the market? Is it bouncing up? Is it going to keep going down, or is it going to keep shooting up? What fundamentals will drive this up? What's going to keep it going? Other than the cash rate. Cash rate's going down, guys. Wages aren't going up. GDP isn't going up. Arrears rates, they're still going up. Building approvals, they're still tracking down. So, building approvals, less supply, but also less people buying, less people employed. So it's just a matter of time. The market conditions have premium leading the way, but the lower end of the market will catch up, she said. Will it? Will it really? Price hikes. It seems it won't take long for the markets to rebound, as the latest data found that house prices climbed in every capital city across January. CoreLogic's data showed the nation's annual house price growth rate to January was 4.1%, but we've just been looking at other examples where we shouldn't take the national anyway. Okay, I guess you need to finish one of these articles on a positive spin. With the median dwelling price in Sydney for January resting at $862,000. Ms. Lawless said housing remained more affordable relative to the heights of 2017, but it was still an issue in the big cities. Australia's attitude toward buying conditions is better than 12 months ago, up 3.4% according to the Westpac Melbourne Institute's Consumer Sentiment Index for January. The Reserve Bank Board may take house prices into account when it meets tomorrow to consider borrowing rates. Well, this is going to be interesting, guys, because once again, the cash rate, I think, and accessibility to credit with the APRA rules are going to have a big impact on this. I mean, our dollar's already going down again today. We'll have to see what happens with the market. It's going to be an interesting year. So, we'll have to see what happens with regards to the rest of the market. What do you think? Do you think we're going to see a climb? or is it all going to go down? Thank you for watching. Please like, share, and subscribe to the channel. If you're a fan and want to help that little bit extra, we have a Patreon where you can make a monthly donation. We also have the ability for you to join the channel here on YouTube, where you can get access to emojis and badges. We have affiliate links with Independent Reserve, Amazon, and eBay. We sell merch on the HeiseSays website. Check that out for pocket squares. And you can make a direct contribution via PayPal or other means. Take care, guys. Have a great day, and I will see you in the next video. Bye for now.